Silver just had one of the biggest single-year rallies in modern market history, up 147%. Now an analyst is calling for $90 silver. But here's the uncomfortable truth. Buy silver the way people did in 2025, and you're the exit liquidity. Today I'll show you why silver could still hit $90 and exactly how most investors would still lose money even if it does. By the end, you'll have a simple 3-question checklist to decide buy now, wait for a pullback, or avoid entirely. The financial world is split over silver. In one corner, you have the bulls pounding the table for $90, maybe even $100 silver, convinced the real story is just beginning. In the other, you have the world's biggest investment banks warning the party's mostly over, with forecasts in the $60 to $70 range. Our job is to cut through that noise, look at both sides, and give you the tools you need to make up your own mind. Here's the rule. You don't need to predict the top, just avoid the worst entry. And I'll show you the exact 3-question checklist I use to decide buy, wait, or pass. To get your head around the argument for a $90 silver price forecast for 2026, you have to realize this isn't your grandpa's piggy bank metal anymore. The bull case is built on 3 massive pillars: a tsunami of industrial demand, a supply chain that's structurally broken, and a financial environment that's making hard assets look better than ever. So here's the bull case in one sentence. A revolution in demand is colliding with a crisis in supply. Let's start with industrial demand because it's the engine driving this whole train. Simply put, silver is the best electrical and thermal conductor on the planet. It's a material that the world's hottest growth sectors just can't do without, and that need is growing faster and faster. Driver number 1, solar. Solar power is an absolutely voracious consumer of silver. Photovoltaic cells use silver paste to move electricity, and even though manufacturers are constantly trying to use less of it, the explosion in global solar panel installations is completely overwhelming those savings. It's estimated that in 2024, solar manufacturing ate up more than a quarter of the entire annual silver supply, and that hunger just kept growing through 2025. The Silver Institute thinks that from 2020 to 2030, silver demand from the solar industry alone is set to nearly double. That alone doesn't get you to $90, but it explains why silver stopped behaving like a precious metal and started behaving like a bottleneck. Driver number 2, EVs. Your standard gas-powered car has a little bit of silver in it, maybe 15 to 28 grams for electronics. An EV, though, needs way more, around 25 to 50 grams per vehicle. Silver is crucial for battery systems, connectors, charging stations, and all the advanced sensors. As the world switches to electric cars, it creates this huge, new, and steady source of demand. This is why silver demand isn't cyclical anymore. It's infrastructural. Driver number 3, AI. All those data centers and high-performance servers powering artificial intelligence use insane amounts of electricity and create a ton of heat. Silver's unmatched conductivity makes it essential for the high-efficiency power components and cooling systems needed to handle it all. This is the part most silver price models completely miss. And this is exactly why silver looks like a no-brainer, which is why it's also dangerous. This trifecta, solar, EVs, and AI, is creating a tidal wave of industrial silver demand unlike anything the market has ever seen. It's not cyclical, it's structural. These manufacturers need silver. They can't just swap it out for something cheaper without sacrificing performance and safety. On screen, demand up, supply downline, volatility. 2 arrows up, 1 arrow down, and 1 landmine. Now here's where the bull case gets even stronger. Let's talk about pillar number 2, the supply crisis. For 5 straight years, the world has used more silver than it has mined. That's not a prediction, it's a fact, confirmed by groups like the Silver Institute. This persistent silver supply deficit was pegged at around 230 million ounces in 2025. If you remember one thing, silver supply can't respond like oil can. The problem is you can't just flip a switch and make more silver. About 70 to 80% of silver is mined as a byproduct of digging up other metals like copper, lead, and zinc. That means silver production is often tied to the market for those metals, not the price of silver itself. So even with silver prices going through the roof, the supply is slow to respond. We're burning through the world's visible above-ground stockpiles to fill that gap, and they're shrinking. Reports in late 2025 pointed to extreme tightness in major trading hubs like London and on the CME Futures Exchange, a classic sign of a physical shortage. Finally, the third pillar is the money side of things. With everyone expecting interest rate cuts in 2026, the cost of holding metal is dropping. Lower rates and a weaker US dollar could make precious metals a much more popular safe haven for investors. In 2025, the US government even started taking steps to add silver to the official critical minerals list. Getting that final designation would reframe silver from just a precious metal to a strategic asset. When you put it all together, unstoppable industrial demand, a persistent supply shortage, and a friendly monetary policy, the case for $90 silver starts to feel less like hype and more like simple math. Some analysts are even more bullish. Alan Hibbert of Gold Silver thinks a move over $100 in 2026 is on the table. And you have voices like Robert Kiyosaki talking about a potential range of $100 to $200. Be honest, are you here because you missed the 2025 run or because you think the real run is still ahead? Put this on the screen because this is the whole video. Here's the real story. Silver has two personalities: industrial silver versus monetary silver, and your returns depend on which one is in control. In a minute, I'll show you the single mistake that blows people up in silver, no matter how bullish they are. The mistake that blows people up is confusing industrial silver with momentum silver and buying both the same way. Because silver doesn't crash slowly, it evaporates. Example, someone hears AI plus solar demand, buys after a vertical move, then silver drops 20% in a week and they panic sell. Fundamentals didn't change, entry did. The road to $90 is filled with potholes, and the same forces that make silver fly can also make it crash and burn. I'm not here to tell you buy or sell. I'm here to stop you from buying the worst entry. This is the case for caution, and it's being made by some of the biggest names in finance. Let's start with what the big banks are forecasting. After 2025's monster rally, their official silver price prediction 2026 has been raised, but they're still way more conservative than the bulls. Bank of America, for example, sees silver averaging around $56 an ounce in 2026, with a possible peak near $65. HSBC is a bit more optimistic, seeing an average around $68, but they also see a massive trading range for the year, from a low of $58 to a high of $88, and expect prices to fall in the second half of the year as supply gets better. Forecasts from other big players like Citigroup and UBS are in a similar ballpark, mostly between the mid-50s and low 70s. Those are still great prices, but they point to a market that's consolidating, not one that's about to double again. So why are they so cautious? The first reason is the primary silver investment risk. It's infamous volatility. Silver doesn't test your spreadsheet, it tests your stomach, and most people fail that test. Its market is smaller and less liquid than gold, which means prices move with terrifying speed, both up and down. That 147% gain in 2025 was a thrill ride if you were already on board. But anyone who's been in this market knows silver can give back 20 or 30% in the blink of an eye. As one analyst from ICICI Direct put it, after a rally that big, the risk-reward ratio just isn't very attractive for new money at these levels. The second huge risk is pure speculation. There's a real concern that the price spike in late 2025 had more to do with hype and momentum than fundamentals. That rally happened during a time of thin holiday trading, which always exaggerates price moves. At the time, market commentators warned that the speculative atmosphere was getting out of control. HSBC flat out warned that prices seem fundamentally overvalued and that a pullback is likely. Then there's the leverage in the futures market. Here's how silver crashes actually start, and it's never fundamentals. Traders use a small deposit called margin to control a huge amount of silver on exchanges like the COMEX. When prices get too wild, the exchange raises its margin requirements. This forces leverage traders who don't have enough cash to sell their positions. That forced selling can trigger a domino effect of even lower prices, and suddenly silver is down 25% in 2 weeks. The fourth counter argument is the risk of demand destruction. Yes, the industrial case for silver is strong, but it's not invincible. At some point, if the price gets high enough, manufacturers will work even harder to use less of it. HSBC's 2026 forecast is specifically planning on weaker industrial consumption and a big drop in jewelry demand because of high prices. They predict that the supply deficit, which was around 230 million ounces in 2025, will shrink to about 140 million in 2026 as supply finally starts to catch up and demand cools off. And finally, you can never ignore gold. For all the talk about silver's unique story, its price is still deeply tied to what gold does. If the gold rally stalls out, it would be almost impossible for silver to keep climbing on its own. Silver often acts like gold on steroids, meaning it gets hit harder on the way down. And if gold rolls over, silver usually gets hit harder. So we have two powerful but completely opposite stories. That's why forecasts are all over the place. On one side, you have a fundamental revolution in demand hitting a crippling supply shortage. On the other, you have a cautionary tale of speculative mania, crazy volatility, and the biggest banks in the world telling you to calm down. How do we put these together to make a smart decision? I think the best way to look at it is as a battle between silver's two different identities: industrial silver versus monetary silver. Industrial silver is the hero of the bull story. It's a strategic commodity, the secret ingredient in the world's transition to green energy and AI. Its value is driven by real-world consumption that's growing every single year. The supply deficits are real, and the problems with mining more are not going away easily. For the $90 price target to happen, this is the version of silver that needs to win the fight. For that to happen, a few things have to go perfectly right. Industrial demand has to stay red hot, even at these prices. Supply from mines and recycling has to fail to keep up, and the global economy has to steer clear of a major recession. Then you have monetary silver. This is the volatile, speculative beast that basically trades like a leveraged bet on gold. Its price is driven by feelings, momentum, futures market gambling, and what everyone thinks the Fed is going to do next. This is the silver the banks are warning you about. For their more conservative $60 to $70 forecast to be right, this is the identity that needs to take over. That would happen if all the speculative hype dies down, leading to a sharp correction. It would also happen if the Fed gets cold feet about cutting interest rates, or if a global slowdown makes investors run for the safety of cash instead of risky commodities. The truth is, 2026 will probably be a messy mix of both. The industrial demand provides a real and solid floor for the price, which makes a total collapse back to pre-2025 levels pretty unlikely. But the speculative froth from that insane rally is also real, and the risk of a major pullback to wash out the excess is very high. The key takeaway here is that the fight between these two identities creates a ton of uncertainty. The long-term case for silver is probably stronger than it has ever been, but the short-term risks are also incredibly high after a 147% run-up in 1 year. Now, more than ever, you have to know if you're investing for the long-term industrial story or just trading the short-term price swings. So, after all that, should you invest in silver right now? The potential for a massive repricing of silver is built on a foundation that you can't deny. A revolution in demand from green tech is crashing into a structural supply deficit that's been going on for 5 years. That is a profoundly bullish long-term setup. However, the risks are just as real. Silver is a notoriously wild ride, and the world's largest investment banks are waving yellow flags. Remember, industrial silver versus monetary silver. Here's the 3-question checklist I promised. Am I buying because of industrial fundamentals or price momentum? Can I survive a 25 to 30% drawdown without panic selling? Is my time horizon measured in months or years? If you answered momentum plus no plus months, you wait. If you answered fundamentals plus yes plus years, you scale in. There are good arguments on both sides. The only wrong move is jumping in without understanding the whole picture. So now I want to turn it over to you. Who do you think's right? The bold analysts calling for a new age for silver, or the big banks telling everyone to be careful? Let me know what your price target is for 2026 in the comments below. And if you found this breakdown valuable, do me a favor and hit that subscribe button and click the notification bell so you don't miss our next deep dive. Thanks for watching.